Welcome to our reading on understanding the balance sheet. Now, our first learning outcome here asks us to describe elements of the balance sheet, and in particular it talks about assets, liabilities and equity. So let's have a look at a balance sheet straight away, and we're looking at an account format balance sheet here with our assets on the left hand side and our liabilities on the right hand side. So when we look at the balance sheet, first thing to notice, of course, is that it balances, i.e. the total of the assets, in this case 420 million, is the same as the total of the liabilities, also 420 million. Well, actually notice it's not just the liabilities, actually liabilities plus equity. And remember from earlier, our balance sheet equation, assets equals liabilities plus equity. Of course, that can be slightly arranged to assets minus liabilities equals equity. When we look at our assets, we can see that they're divided into two types, if you like, our current assets and our long-lived assets. Our current assets are typically assets that are going to be consumed within the next business cycle. Our long-lived assets are assets held for long-term use within the business. So typically our long-lived assets, therefore, represent the infrastructure out of which the firm is operating. And we can see we've got investments here, some property, plant and equipment, and also some intangibles. When we look at our liabilities, and remember these are amounts owed to third parties, we can see that those are split into two types as well. Our current liabilities, so liabilities falling due for payment within the next business cycle, and our long-term liabilities, liabilities falling due for payment after the next business cycle. And again, we'll describe those terms in more detail a little later. And there's our owner's equity, comprising of contributed capital and retained earnings. Now you'll remember maybe from earlier readings that we said we may also see other comprehensive income items within equity. So here's our definition of an asset. Remember, an asset is a probable flow of economic benefit to the entity. In other words, it will represent inflows of benefit, of often cash, into the company. Notice our second bullet point there, measurable with reliability. In other words, we need to be able to put a reliable monetary value on our asset. So let's have a look at some various types of assets we may find. Cash and equivalents. Well, cash, of course, is money held in bank accounts. Cash equivalents are typically short-term money market instruments. So that's typically debt instruments, and often they have less than 90 days to maturity to qualify as a cash equivalent. Inventories, so these are our raw materials, our work in progress and our finished goods. Trade and other receivables, sometimes referred to, of course, trade receivables can sometimes be referred to as accounts receivable, being the amounts that our customers owe us at the balance sheet date. Other receivables just being any other amounts that the company is owed at the balance sheet date. Prepaid expenses, you've paid for a good or service, but you've not yet used it. Now remember, the accruals process says, therefore, if you've not yet used the good or service, it can't show up in the income statement, so instead we're going to create an asset. When we use the good or service, we'll eliminate the asset and we'll put the expense into the income statement. Financial assets, we may well see financial assets. In particular, we might see some passive assets. In other words, assets that are held but we have no influence, no control over the other entity. And we're going to look at those in some detail a little bit later. But we might also see some other longer term assets. In other words, maybe financial assets held in other group companies, such as associates, such as subsidiaries. Deferred tax asset, and we're going to look at deferred tax in some detail in a later reading. Now, a deferred tax asset, all we need to know now is we've paid essentially more tax now and we'll pay less tax at a future date. And because we're paying less tax at a future date, it means smaller outflows of benefit, and therefore we'd class this as an asset. Property, plant and equipment, so these are the tangible fixed assets, the infrastructure with which the company operates. The idea is this is going to help us generate revenues over a number of periods. So we're going to store the cost initially in the balance sheet, and then we're going to release it through the income statement over a number of periods. And of course, the mechanism for that will be depreciation. Investment property, well, this is a classification we only really see under IFRS. This is property that's really held purely for its rental potential or its capital appreciation. So it's really more of an investment rather than an asset that you're using in the course of your business. Intangible assets, again, represent infrastructure that we're going to use within the business, but it has no physical form. Goodwill being the most common, but we'd also see things like patents, royalty agreements, as well with our intangibles. Equity accounted investments represent associates. Associates, you might well see them called affiliates in the exam. These are other companies where we have an influence over them, but not outright control. And we use a method called equity accounting. Now, we're not actually going to see that method in any great detail until we hit the level 2 syllabus. Natural resources, so things like oil fields, minerals, that kind of stuff, again, may well be held as assets in the balance sheet. And then our last classification down there are assets held for sale. Broadly speaking, our assets have two classifications. Assets held for use, the assets that we're going to use within the business, such as our property, plant and equipment, and assets held for sale. Now, an asset held for sale was an asset held for use, but we've now made the decision that we're going to sell off that asset. And once we make the decision that we're going to dispose of an asset held for use, it gets taken out of asset held for use and gets put in to assets held for sale. Now, when it goes into assets held for sale, we stop depreciating it. Okay, let's turn our attention to liabilities. Well, if an asset was a probable inflow of benefit, then essentially a liability is going to be a probable outflow of benefit. So let's have a look at our bullet points. A probable sacrifice of economic benefit to the entity as a result of past transactions. So indeed, it's representing an outflow of future benefit. Amounts received but not reported as revenue in the income statement. Now, we mentioned this in a prior reading. This is when essentially a customer pays us in advance. Pays us in advance of what? Well, the earnings activities being complete. We're not allowed to record a sale until our earnings activities are complete. So if the customer pays us in advance, obviously our cash goes up, but we can't record a sale in the income statement. So what we essentially do is we create a liability called deferred or unearned revenue. Once the earning criteria are met and we can record a sale, we're going to eliminate that liability and report it as a sale in the income statement. Okay, amounts reported as expenses which have not been paid as well, typically we'll refer to those as accruals. If we've incurred or we've used a good or service, but we've not yet been invoiced for it, then there's no sign of it in the year-end accounts. Instead, we have to make one of those accruals valuation adjustments. So the idea is, even if you've yet to receive the invoice, you still need the expense in the income statement. So we're going to put an estimated expense in the income statement and create an accrual, a liability, in the balance sheet. So let's have a look at some of our liabilities. Bank borrowings, so in other words, loans, overdrawn bank accounts, that kind of thing. Notes payable. Notes payable are typically short-term interest-bearing borrowings. Provisions. Provisions, remember, are estimated future expenses. And of course, the accounting rule of prudence says as soon as you can foresee an expense, you should account for it. So it should go into the income statement and we should create a liability. Unearned revenues, well, we just mentioned that the customer has paid you in advance of the earnings activity being complete and therefore you can't record a sale. So rather than going into sales, we create that liability and then reverse that liability into sales when the earnings activity is complete. Accounts payable or trade payables, the flip side of accounts receivable or trade receivables. In other words, accounts payable means we've made purchases before the year end but haven't paid the supplier until after year end. So these amounts represent amounts owed to our suppliers at the balance sheet date. Financial liabilities, well, these could of course be any other liability that we have, debt instruments particularly in here, but you could have derivatives, other instruments as well. Accrued liabilities, well, as we said, an accrual is simply where you've incurred a cost. You know that you've used something, a service, or you've used a good, but you've yet to be invoiced for it. Because you haven't been invoiced for it, it's not in the books, the journals, the debits and credits that generate the accounts. So instead, we need to make a year-end adjustment for it. If we've used a good or service, we need the expense in the income statement regardless of whether we've been invoiced or not. So therefore, we're going to have to estimate the expense, and we're going to put the expense into the income statement and create a liability, an accrual in the balance sheet. Deferred tax liabilities, as mentioned earlier, we're going to look at deferred tax in some detail in a later reading. What do we need to know now? Well, I think as long as you know deferred tax liabilities arise because we pay less tax now, but it will result in us paying more tax in the future. And because we're paying more tax in the future, it's an outflow of future benefit, and therefore it meets the criteria of a liability. Let's have a look at our equity as well. Now, here's our balance sheet equation. Remember, our basic balance sheet equation is assets equal liabilities plus equity. If we deduct liabilities from both sides, we get asset minus liabilities equals stockholders' equity. And that's why stockholders' equity is sometimes described as a residual. Take the assets, deduct the liabilities, anything left over is going to belong to your shareholders. Now, of course, assets minus liabilities typically is going to get the phrase net assets in the exam, but be on your guard, alternative name for it, net worth. So let's have a look at our capital characteristics. It's permanent. What does that mean? Well, typically shares don't have any redemption date on them. They're not going to redeem. The company's not going to have to pay them back. There's no mandatory charges against earnings. In other words, yes, shareholders may receive dividends, but those dividends are completely discretionary. The managers of the company get to choose the dividend and essentially whether to pay a dividend at all. So there's no mandatory charge. No dividends actually have to be paid. Legal subordination to creditors is really just talking about a liquidation scenario. So if the company is liquidated, the assets sold off and used to pay down the liabilities, all of our liabilities get paid off first before anything is received by the shareholders. So they're subordinated to the creditors. They're subordinated to third-party liabilities. They'll only get cash back after all our liabilities are paid. Now, our LOS then turns to describe the uses and limitations of balance sheet analysis. Well, we can see the uses there, assessing liquidity. Now, liquidity is typically the ability to pay off our short-term liabilities as they fall due. Solvency. Now, solvency is really looking at long-term liabilities. So it's going to be looking at things like the debt-to-equity ratio when we look at solvency. And ability to make distributions to the shareholders, i.e. pay dividends. Limitations. Now, we're asked about the benefits. So the benefits, we can assess liquidity, solvency. But what are our limitations? Limitations, well, the first one we've got is mixed measurement conventions. In other words, some assets and liabilities sit there at historic cost. Broadly speaking, historic cost is purchase price or amortized cost. Now, amortized cost really applies to debt instruments. What does it mean? It means purchase price less any amortized premium plus any amortized discount. Essentially, premiums and discounts to par. Don't worry about that right now. Again, we're going to see it in a later reading. So either they sit at cost or amortized cost, or alternatively fair value. Now, fair value means essentially marking to market. So we've got a mixture. Some things are at historic cost, original purchase prices. Some things have been revalued to their current fair values, their current market values. Fair values may change after balance sheet date. Well, absolutely. This is simply saying when we look at the balance sheet, we're seeing the fair value of assets, or certainly certain assets, certain investments particularly, PP&E and intangibles can be revalued as well under IFRS. So we're seeing their fair values at the balance sheet date. Now, of course, the balance sheet date could be some time ago, and those fair values could have changed subsequently, and we're not going to pick that up when we look at the financial statements. Now, the third point, and this is a nice key one, off-balance sheet assets and liabilities. Now, the scope for off-balance sheet assets and liabilities has been dramatically reduced over the last decade or so, but some still do exist. In particular, the major form of off-balance sheet asset and liability we have are operating leases. So this is when a company leases in an asset, but under the classification operating lease, we don't see the asset in the balance sheet, we don't see the liability in the balance sheet either. Now, this is quite controversial because surely this asset, you've leased it in and you're using it, it's part of your infrastructure, but we're not seeing it in the balance sheet. And you've got a commitment to make future rental payments under the lease, and yet we're not seeing any liability. So operating leases really represent our major off-balance sheet finance at level 1. There are a few other things such as take or pay arrangements, and again we'll discuss those a little later. Balance sheet formats, we're asked to describe alternative formats of the balance sheet. Two major ones that we've got here are our report format and our account format. Now notice the report format, assets, liabilities and equity all shown in a single column. Now our account format, and that's essentially what we saw earlier on when we were looking at the balance sheet in this reading, we have the assets on the left hand side and we have our liabilities and equity on the right hand side. Now most balance sheets that you're going to look at are going to be classified. We're going to group accounts into subcategories. And of course the typical categories we see are current and non-current for both assets and our liabilities, but we might also see financial assets versus non-financial assets. Be a little bit aware as well that you may see liquidity-based presentation. So assets listed in order of liquidity, i.e. how close they are to cash or how easy they are to convert into cash, and liabilities listed in due date essentially. And that's very common for financial institutions in the banking sector, for example. So let's turn our attention to current assets. We've got two LOSs here, distinguish and describe. We've got to distinguish between current and non-current assets and liabilities, and we've got to describe types of current assets and current liabilities and measurement bases as well. So let's start with our current assets. So our current assets, cash and other assets that will be converted into cash or used up within 1 year. And that's the broad rule here. It's typically going to be 1 year or one operating cycle, whichever is greater. Now, for most firms, the operating cycle is going to be less than 1 year, and therefore the definition of a current asset is simply an asset that's going to be consumed within 1 year. What is the operating cycle? Well, notice it's the time it takes to produce inventory, sell the product, and collect the cash. So it's a little bit like the cash operating cycle that we'll see within our ratio analysis. What essentially it is the length of time between receiving raw materials, producing the good, selling the finished goods, and then finally collecting the cash from your customer. So that total length of time in days is known as the cash operating cycle. Okay, so again, typically most firms will have an operating cycle that is less than 1 year. Okay, but maybe you should just be a little bit aware that some maybe don't. Now, current assets are presented in the order of liquidity. Most common, therefore, is we see the most liquid asset first in our balance sheet. And of course, the most liquid asset is cash itself. And as we run down our list of assets, we're getting less and less liquid. Current assets reveal information about the operating activities and the capacity of the firm. Yeah, current assets represent a component of our working capital, the capital that we're using in our day-to-day operations. So we're seeing information on our sales when we look at accounts receivable. We're seeing information on our production process when we look at inventory. So let's have a look at our current assets, and we need to start talking about their measurement basis. In other words, how are they recorded in the balance sheet? So our cash and cash equivalents, you can see these are typically going to be amortized cost or fair value. Now cash itself is always by definition at fair value. Cost is fair value for cash. Cash equivalent, these short-term money market instruments, typically will hold those at amortized cost. So initially they go into the balance sheet at the purchase price, but then we amortize them so that asset, if you like, increases to par value over the life. Now, marketable securities. Our marketable securities, again, we've got a blend here. Some are going to be amortized cost, in particular, a type of security called held to maturity, and that only applies to debt, and we're going to be looking at that a little bit later, but others at fair value. We're going to have three major classifications of marketable securities: held to maturity, available for sale, and trading. We're going to see that held to maturity is held at amortized cost, and we're going to see that available for sale and trading securities are held at fair value. Accounts receivable, trade receivables at their net realizable value. In other words, remember, our accounts receivable represent the amounts of cash that our customers owe us at year-end date. So they bought goods on credit but not yet paid us at the balance sheet date. Now, notice it says net realizable value. We know some of our customers will default, and therefore we need to net a bad debt provision against the accounts receivable. So we put in the total amount that the customers owe us and then deduct how much we think will default. Now, of course, that bad debt provision is an estimate. It's essentially our guess, probably based on past experience of the total amounts of defaults that we're likely to experience. And therefore, the asset represents the cash that we're actually likely to collect, rather than the cash that is actually owed in total. Now, our inventories, now we've said they contain raw materials. Those are our component elements that we're going to use in a production process, work in progress, and finished goods. Work in progress is simply where you've started to construct a finished good but haven't completed it at the year-end date. So it means partially constructed products. And then finished goods, these are the goods that we've completed but not yet sold. Now, manufacturing, what happens if we actually produce our own goods? Now, typically we value our inventory at cost, and we're going to use the standard cost of production. So we're going to ignore any non-standard cost, any cost overruns, and we're going to use the typical cost of producing our goods, if you like. Cost flow methodology, this is often used for our raw materials, potentially if we're a manufacturing company, but it's used for finished goods if you're a trading company. And when I say a trading company, I simply mean a company that buys in goods and then sells them on, isn't actually involved in manufacturing. Now, when we come to value our ending inventory, we've got three methods. FIFO, that's going to stand for first in, first out. Essentially, we value our ending inventory here at the most recent purchase prices. LIFO, that stands for last in, first out. Here we value our ending inventory at the oldest purchase prices. And AVCO, which means average cost, here we value our ending inventory at the average price during the year. Again, later reading, we're going to have a good look at inventory valuation. Prepaid expenses, these are simply going to be recorded at the price we paid, essentially. So it's going to be historic cost. Deferred tax assets, and it says net of a valuation allowance. Let me remind you of a deferred tax asset. We've paid more tax now, but this will result in us paying less tax in the future. Now, what that essentially means is you need to be profitable in the future to benefit from deferred tax assets. If you're not profitable, you're not paying tax, and therefore you can't benefit from paying less tax. Now, this valuation allowance that this slide is talking about here is looking at the profitability. What we have to do is reduce the deferred tax asset if we think that future profitability will be insufficient to benefit from it. So again, it nets, this valuation allowance nets against the deferred tax asset and reduces it. Other side would be the income statement. Now, what that does mean is if you see valuation allowances in a set of accounts, it does mean that you should really consider the future profitability of the company. If they thought that profitability would be high going forward, they wouldn't have a need for valuation allowances because they would be able to benefit from the full reversal of deferred tax assets. So if you like, a valuation allowance is an indication that maybe the future isn't that healthy and maybe profitability needs to be analysed very carefully by the analyst. Now, inventory, the lower of cost. Now, cost, of course, if you're a manufacturing company, is standard cost. If you're a trading company, we're going to use those FIFO, LIFO, and average cost rules. Now, the rules under IFRS say we need to hold our ending inventory at the lower of cost and net realizable value. Now, net realizable value essentially is the expected selling price less any additional costs incurred, in particular selling costs. Okay, now, if net realizable value is above cost, we don't have a problem. The inventory simply sits there at cost. But we do have a problem if net realizable value falls below cost. Now, if net realizable value falls below cost, essentially what we've got here is a write-down. Now, a write-down, you might remember, is one of those unusual or infrequent items. So it's going to go into the income statement if it's material. It's going to be separately disclosed in the income statement, but it goes before the tax line. So we report gross, and any tax implication is included in our tax expense. Okay, so let's have a quick look at our points on this one. So cost, remember, if you're a manufacturing company, it's the standard cost. Remember, therefore, it's going to exclude any abnormal amounts. And it's only the cost of getting your inventory into its current location and finished condition. In other words, any storage cost for finished goods cannot be included in your inventory valuation. In fact, we've got some exclusions. So we exclude abnormal amounts. Why is that the case? Well, because it's the standard cost of production. We exclude storage costs for finished goods. Why? We can only include the cost involved in getting your goods into their finished condition. Storage costs of finished goods are after that. Exclude any admin overheads. Why? Because those are not directly related to the production process. So production overheads, those could be included, but admin overheads, so sales, general and admin type things, those are not going to be included because they're not directly related to the production process. And any costs of selling those products, again, are excluded from our inventory cost. Again, only the cost of getting your goods into their finished condition. Now, as we said, net realizable value itself is the estimated selling price less the estimated cost of completion and selling costs. Now, this estimated cost of completion really is only going to kick in for work in progress. If you're looking at finished goods, there are no additional costs to complete the item. If you're looking at work in progress, remember it's partially completed, so you are going to incur some additional costs to get it into its finished state, and therefore you would need to include those here. So notice IFRS uses the law of cost and net realizable value. US GAAP, slightly different rule, the law of cost and market value. Now, what is market value? Typically, market value is replacement cost, what it would cost to replace this inventory, but it's subject to an upper and a lower limit. The upper limit is net realizable value, and the lower limit is net realizable value minus your normal profit margin. So if replacement cost is within those limits, that's what you use. If replacement cost goes above net realizable value, you use net realizable value. If replacement cost goes below net realizable value minus margin, you use NRV minus margin. So let's have a look now at our non-current assets. So these are assets that are not going to be consumed within the next business year or the next operating cycle. These are therefore assets held for continuing use within the business and not resale. Now just be careful with that not resale line there. It doesn't mean we can't ever sell these assets. It just means that when we purchased them, the intention was to use them within the business rather than to sell them on and try and make a profit. So really, when we look at our non-current assets, we're talking about the infrastructure of the company. And we're going to be applying the accruals concept here. Because the infrastructure of the company is going to help generate revenues and profits over a number of years, we need to apply the accruals concept, and within that, the matching concept. And the matching concept says you need to match costs against revenues. So if the revenues are generated over a number of periods, we need to spread the cost of this asset through the income statement over a number of periods. And as we mentioned, mechanism to do that will be depreciation for a tangible asset, amortization for an intangible. Okay, so as we said, there they are. They're the infrastructure from which the company operates. In terms of cash flow, they're going to go from our cash flow from investing, CFI. So they're the investing activities of the company. Now, you can see our long-term assets broadly split into two classifications, our tangible assets, and of course this includes our property, plant and equipment, but it's a bit beyond that. It would include any natural resources that the company owns as well. So our tangible assets are simply assets with physical form, i.e. you can touch, you can feel, you can hold them. So our intangible assets, these two are going to be infrastructure, but the key is these have no physical form. You can't touch, feel or hold these. So these, as we mentioned, are things like copyrights, patent agreements, trademark, franchise licenses, but probably the most famous of all is goodwill. Goodwill arising on acquisition of subsidiaries. Investment property, we mentioned this, only exists under IFRS, and our investment property essentially is property held for its investment potential, i.e. its rental potential and its capital appreciation. So it's not really an asset that we're going to use within the normal day-to-day business operations of the company. So it has its own unique classification. So tangible assets are going to be depreciated and natural resources are going to be depleted, says our learning outcome. Now, the idea behind capitalization, and all capitalization really means is storing in the balance sheet, is applying this matching concept. We said this infrastructure is going to help generate profits over a number of years, and the matching concept says we must match revenues to we must match costs, to our revenues. So if we're generating revenues and earnings over a number of periods, we need to spread the costs of these assets over a number of periods. So initially, the cost of the asset is going to be stored in the balance sheet. Then we're going to release it into the income statement to match against earnings over a number of periods. And of course, the mechanism for that, for a tangible asset, is depreciation. For natural resources, it's referred to as depletion. Now, virtually all of our tangible assets are going to be depreciated. There is one exception to that rule, and that, of course, is land. Often you'll hear the idea of depreciation as being described as spreading the cost of the asset over its useful life. Now, of course, let's think about the useful life of a piece of land. Well, of course, it's almost the same as it is the same as the planet Earth. So if you were to spread the cost of land over the life of the planet Earth, the amount would be so small, it's not worth doing. So therefore, we don't depreciate it. Other tangible assets, such as buildings, machinery, have finite lives, and therefore we do depreciate them. Now, natural resources, so maybe we own an oil field, let's say. These are going to be used up over time. Now, as we use the natural resource, we're essentially extracting the natural resource and we're converting it into inventory. So the measure that we're going to use to measure the extraction of the resource and the conversion of it into inventory is known as depletion rather than depreciation. So, balance sheet book values are, now remember, whenever we talk about a balance sheet value, they could in the exam say the balance sheet value, they could simply call it the book value, or they could call it the carrying value. All three terms mean simply the value reported in the balance sheet. So let's look at our depreciation and depletion. So when we look at our PP&E, we're going to see typically under US GAAP and IFRS, historic cost of the assets. So the price that you paid when you acquired your machinery, when you acquired your land and buildings, that's our historic cost, the purchase price. But then we're going to deduct accumulated depreciation. Now, our accumulated depreciation is simply a running total of the amount of depreciation that has gone through the income statement so far over the asset's life. Now, of course, if you're looking at a natural resource, then you look at the cost, the purchase price, less accumulated depletion. So typically our carrying value, therefore, is historic cost less the total, the cumulative total of depreciation that's gone through the income statement. And of course, that's referred to as accumulated depreciation. So historic cost minus accumulated depreciation. Now, it does say unless asset values are impaired. Now, this is very similar to the inventory write-down that we talked about earlier. What is an impairment? Well, the fair value of the asset has declined below its carrying value. Now, again, that means we've got essentially to write it down. We don't call it a write-down in this situation, we call it an impairment. But again, it's another one of those unusual or infrequent items, and we're going to look at the rules for impairing assets a little later. So, typically carrying value, historical cost less accumulated depreciation. Notice there's an alternative under IFRS. Under IFRS, we can use fair value less any accumulated depreciation. Now, of course, fair value is the current market value or estimated market value of the asset. In other words, IFRS has a provision that allows you to revalue your tangible assets if you want to, and actually it's your intangible as well. Okay, so you can revalue and record at fair value under IFRS, but note, not under US GAAP. Our intangibles, we broadly split these into identifiable intangibles and unidentifiable intangibles. Our identifiable intangibles intangibles can be acquired singularly. In other words, you could go out and buy this. A royalty agreement. I could go out and pay for a royalty agreement. Okay. Now notice it says it's linked to rights, privileges that have finite benefit periods. So maybe if I buy the royalty or buy a royalty agreement for a particular piece of music, maybe I bought it for 10 years, so I will receive the royalties for a 10-year period. It's got a finite period of time. Now, because there's a finite period of time over which we'll receive benefits, we're therefore going to have to amortize. Now, amortization is simply the name that we use for depreciation of intangible assets. So what we're going to do is store the cost of the intangible asset into the balance sheet and then release over a number of years as we essentially receive the benefits from using that intangible. And that method of spreading its cost over a number of different income statements is referred to as amortization when we're dealing with intangibles. Unidentifiable intangibles. These are ones that you can't go out and buy separately. Now, a really good example that we put in here is goodwill, which is probably the most classic. Now, goodwill is the difference between essentially what you pay to acquire a subsidiary and the net assets of that subsidiary after they've been adjusted to fair market value. In other words, it's the excess that you pay in order to acquire a company over the fair market value of its net assets. Now, why do we pay this excess? If you look at the definition of goodwill, it would be saying, well, look, this is what we're paying for everything that isn't in the balance sheet. The reputation of the company, maybe its brand name if it's internally generated, its relationships with customers, its relationships with suppliers, employees, etc. So everything that's not in the balance sheet. Now, you can't go out and buy that separately. You can't buy the goodwill. You have to buy the entire company, i.e. all of its net assets, and the goodwill comes with it. So that's what we mean by it's unidentifiable. You can't simply go out and buy goodwill. It's actually arising on a transaction where you buy an entire company. Now, of course, there's no finite life for this. Goodwill should not erode necessarily over time, and as a result, we're not going to amortize this. But when we don't amortize, we are compelled to do an annual impairment review to check for impairments. So let's have a look at our intangibles. It says they may only be recognized if they can be measured reliably. In other words, we can put a monetary value on these assets. Now, what that means is internally generated intangibles typically cannot be included. What do I mean by internally generated intangibles? Things like brand names. Maybe you've developed your brand name over a period of time and you've reinforced it by marketing expenditure, etc. Now, because you've internally generated it, problem is, how much is it actually worth, that brand name? How do we put a reliable monetary value on it? The idea, or the view that the accounting rules take, is it's too subjective. It's too difficult to put a value, essentially, on these internally generated intangibles, and therefore we're not allowed to include them. Now, if we'd gone out and bought somebody else's brand name, we would be able to include it. Why? Because we can put a reliable measure of cost on it. It would simply be the price that we paid to acquire it. So let's have a look at what we're looking at with our intangibles. Purchase, patents and copyrights. Purchase, brand names and trademarks. So notice we're excluding intangibly generated items there. Direct response advertising. Now this is internally generated, but it can be capitalized. This is a particular form of advertising. This is essentially where the customer has a direct response and can buy the product. So it would be things like cold calling, perhaps, where you're actually phoning up customers and trying to get them to buy. If you can prove there is a direct link, and there has been a link in the past between incurring this expense and having higher future sales, and that your market hasn't substantially changed, then you are allowed to capitalize direct response advertising. Normal advertising, where you're just saying, look at our products, aren't they beautiful, don't you want to buy them? So TV advertising, that kind of stuff, typically cannot be capitalized. And the reason for that is we don't know for certain whether it will lead to higher future sales, higher future revenues, and therefore we take a prudent approach and expense it when it's incurred. So direct response advertising can be, but most other advertising can't be. Purchase, franchise and license costs, goodwill arising on an acquisition, and notice as well computer software development costs. Now again, the rules around computer software development costs are a little bit technical, but broadly speaking, the rule is roughly says any costs in establishing the software's feasibility needs to be expensed. Any costs after feasibility has been established can be capitalized. What does feasibility actually mean? The software does what it was meant to do. Now, once that's been established, the software does what it's meant to do, any additional costs then can be capitalized, maybe making the user interface pretty, that kind of stuff. Now, of course, again, think about this, how easy it would be for a company to mislead the auditors. The auditors aren't going to understand whether the software is technically feasible at a stage in time, and therefore they're really reliant on the company telling them truth. So it could be an area that is easy to manipulate. So let's have a look at our expensed items. Internally generated brands and mastheads. Mastheads are really kind of company logos. Publishing titles, customer lists. Startup costs, the cost of starting up a business, typically has to be expensed when that business is set up. It can't be stored in the balance sheet and then amortized. There are some exceptions to that rule, but certainly if you learn that startup costs have to be expensed for level 1, that would be fine. Training costs, the cost of training employees. Now you might well argue if we train our employees, they're going to be better employees, they'll generate higher revenues, and if they generate higher revenues, surely I should apply the matching concept and spread the cost of this training over the revenues they generate. Argument here is that's just too subjective. We don't know whether training will be effective, we don't know whether it will translate into higher revenues, so let's take a prudent approach and let's just expense. Admin and general overheads, well, of course, these are the costs of running the company. They're incurred in the period in which or expensed in the period in which they're incurred. Advertising and promotion. So again, remember, the direct response can be capitalized, but most advertising and promotion that's really reinforcing brand and product image, we don't know whether it's going to be successful, and therefore we take a prudent approach and expense. Relocation and reorganization costs, again, expensed when incurred. Redundancy and termination costs, expensed when incurred. Here's an interesting one, research and development. Here's a little bit where IFRS and US GAAP differ. Now, US GAAP says both research and development expenditure should be expensed. Research, of course, is pure research. Development is product development, so you're actually developing a product for launch. US GAAP says both have to be expensed. IFRS takes a slightly different approach. Research has to be expensed. IFRS says, well, look, you never know whether this research will lead to a profitable future product, so it's too dangerous to capitalize and then amortize. It's better to expense. But development expenditure can be capitalized if certain rules are met, and we're not asked what those rules are for our level 1 exam. Broadly speaking, though, just to give you an idea, the rules are looking at, will it lead to a product that is launched, and is that product likely to be profitable? If the answer is yes to those, then product development costs can be capitalized under IFRS. Now, goodwill. Just be a little bit aware of goodwill. I don't think you need to worry too much about it. It's not until we get to the level 2 syllabus that we look properly in detail at the accounting of subsidiaries. So goodwill is when you essentially acquire a subsidiary company. And it's the difference between the price that you pay and the fair market value of net assets that you acquire. Okay, so the difference between acquisition price and the fair market value of the acquired firm's net assets. What does this fair market value mean? Well, of course, in the balance sheet, a lot of a company's assets will be at historic cost rather than fair value. So it means when we acquire a subsidiary, what we actually have to do is we run down their balance sheet and we adjust assets and liabilities from historic cost, where they're reported at historic cost, to fair value. So it's the net assets after making these fair market value adjustments, and we compare that to purchase price. Purchase price, of course, is typically bigger, and therefore the difference is referred to as goodwill. Now notice, we're simply saying here that the additional amount paid represents the amount paid for assets not recorded on the balance sheet. So maybe these expensed intangibles like brand names that we mentioned earlier, maybe relationships with suppliers, customers, employees, etc. So the accountants would argue that it is what we're paying for the assets not recorded on the balance sheet. As an analyst, we might be ultra cynical and simply say goodwill is generated because we simply pay too much for the company. Now, be aware that when we acquire a subsidiary and we make the fair market value adjustments to their balance sheet, that does involve subjectivity, and it can potentially be manipulated. Typically, there's an incentive here to make the fair market value of the net assets that you've acquired in the subsidiary smaller. Because if you make them smaller compared to purchase price, you make goodwill essentially bigger. And goodwill is not amortized, so it's not going to have any future impacts in income statements. Well, that's providing it's not impaired, of course. Whereas, if you increase the fair market value of net assets, so let's say we revalue PP&E upwards, that is going to have a impact on future income statements, because a higher value for PP&E means more depreciation, more cost to spread over that asset's life. So there's an incentive to minimize the fair market value of net assets and maximize goodwill to have smaller impacts on future earnings. Goodwill analysis. As we said, accountants would say this is what you're paying for all of the assets and all the net assets that are not included in the company's balance sheet. As an analyst, we might simply be a bit more pessimistic than that and say, well, goodwill is simply generated because you paid too much for the company. Now, as a result of that, goodwill simply represents overpayment to acquire a subsidiary, that's not going to generate future earnings. And if it's not going to generate future earnings, it's not really an asset. Where's the inflows of economic benefit? Therefore, a lot of analysts are going to remove the impact of goodwill from financial statements. So they're going to take goodwill out of intangibles, remove it out of intangibles. If there are any impairments relating to goodwill in the income statement, they might remove that as well. Okay. So in other words, we might try and strip out the impact of goodwill in financial statements if we believe it is not genuinely an asset.